Welcome to the Rich People Club. By the end of this video, you'll know exactly how to turn your paycheck into a tool for building wealth. Yes, I'm talking about becoming rich. Starting with the same income you already have. You'll learn the powerful steps to manage your salary so effectively that every dollar works for you, not against you. If you want to be rich, do this every time you get paid. Most people's money vanishes before they've even had a chance to use it wisely, thanks to subscriptions, takeout, and impulse buys. But this video will show you how to break that cycle and turn your paycheck into the foundation of real financial success. Understand your spending and reduce fixed costs. When it comes to managing money, most people don't even know where it goes. That paycheck comes in, and within days, poof, it's gone. Here's the first key. Track every dollar like a hawk. Think of your bank statement as a map, and those small charges like coffee runs or subscriptions are the hidden traps. Without knowing where your money leaks, building wealth becomes an uphill battle. Splitting your spending into wants and needs might seem basic, but it's a game changer. Needs are essentials. Rent, groceries, insurance. Wants? Those are luxuries. Your daily frappuccino or that new gadget. It's like drawing a line between survival and indulgence. Go through 6 months of your bank statements, and you'll quickly see which side eats up more of your money. For most, the needs column feels untouchable. But here's the secret, it's flexible. Do you really need the high-rent apartment, or could you move further out and save hundreds monthly? Could you drive a used car instead of leasing a new one? Big changes might feel daunting, but the payoff can be the financial breathing room you've been craving. Let's talk numbers. Ideally, your needs shouldn't gobble up more than 25% of your income. That might sound impossible, but think of it as a target, not a rule. For example, if you earn $4,000 a month, aim for $1,000 on essentials. The less your fixed costs, the more freedom you'll have to grow your wealth. Not ready to make big changes? Start small. Cancel unused subscriptions. Those $10 a month services add up fast. Or skip eating out every week. Think of it this way. Every unnecessary dollar spent is a dollar you could be investing. Every little cut today could mean an extra zero in your bank account tomorrow. Here's a practical exercise. Get a pen and divide a page into 2 columns. Wants and needs. List out all your expenses from last month. Surprise! That gym membership you never use? That's a want. The weekly sushi dinners? Definitely a want. It's not about depriving yourself, but about recognizing where your money flows. Once you know your financial baseline, you can start optimizing. If rent eats up 50% of your income, consider moving to a more affordable place. If your car payment is too high, trade it in for something cheaper. Each adjustment might sting at first, but you're trading short-term comfort for long-term success. There's a mindset shift here. Cutting costs doesn't mean living poorly. It means living wisely. Think of it as crafting your own luxury. True wealth isn't about spending. It's about control. Would you rather flash wealth today or quietly build a future where money isn't a worry? People often think, I can't save because I don't earn enough. But saving is less about income and more about habits. Take someone earning $50,000 who saves 20%. That's $10,000 a year. Compare that to someone earning $100,000 and spending it all. Who's richer in the long run? A major pitfall is lifestyle inflation. As income rises, so do expenses. Nicer cars, bigger homes, flashier vacations. Resist the urge to upgrade too fast. Instead, keep your spending steady as your income grows. That's how millionaires are made. Not by earning more, but by spending less. Think of your financial baseline as your safety net. Once it's low and manageable, you're free to dream bigger. Imagine allocating the money you save toward investments, travel, or even early retirement. Freedom is the ultimate luxury, and it starts with understanding your expenses. Reducing fixed costs isn't glamorous, but it's the foundation for wealth. Once you've got this down, you'll have more cash to put toward the next step, creating an emergency fund. If you're enjoying this content so far, give this video a like and subscribe to the Rich People Club. It's a small step that helps us bring you even more strategies to build your financial future. Create an emergency fund. Life is unpredictable, and an emergency fund is your financial shield. Without it, one unexpected expense, a car breakdown, medical bill, or sudden job loss, can spiral into a debt nightmare. Start by setting aside 20% of each paycheck in a high-interest savings account. The goal? To have enough money to cover at least 3 months of your basic living expenses. Think of this fund as your financial safety net. It's not for splurging on vacations or a night out. It's for true emergencies. Imagine the peace of mind knowing you can handle life's curveballs without resorting to credit cards. If saving 20% feels daunting, start smaller. 10% or even 5%. And gradually increase it as your habits improve. Choosing the right account is critical. Opt for a high-interest savings account with no penalties for withdrawals. For instance, in the US, Ally Bank offers competitive rates, while in the UK, consider Chase. Keeping this account separate from your daily expenses makes it harder to dip into and ensures your safety net grows steadily. Let's say your financial baseline is $2,000 per month. Your emergency fund should ideally cover $6,000 to $12,000. Break this target into smaller milestones, saving the first $1,000, then moving up. Progress feels achievable when it's broken down, and every small victory fuels your momentum. Emergencies don't wait, so automate your savings. Set up a direct transfer right after payday to make saving effortless. Treat this transfer as non-negotiable, like paying rent or a utility bill. Automation takes the decision-making out of the process, making it easier to stay consistent. Building an emergency fund requires patience, but think of it as buying yourself freedom. With every dollar saved, you're gaining control over your financial future. It's not just money in the bank. It's the confidence to face life head-on without fear of financial ruin. You might wonder, when can I stop saving for emergencies? The answer is when your fund reaches a size that allows you to sleep at night without financial worries. For some, that's 3 months of expenses. For others, it's 6 months or more. Your comfort level dictates the goal. Picture this. Your car suddenly needs $1,500 in repairs. With an emergency fund, you pay the bill and move on. Without it, you'd likely rely on high-interest credit cards, plunging into debt. The difference? One path keeps you financially stable, the other digs a deeper hole. Avoid the temptation to dip into this fund for non-essentials. That extra pint of beer or a last-minute gadget purchase doesn't count as an emergency. Discipline is key. This fund exists to protect you from true financial disasters, not to bankroll impulsive decisions. Statistically, a significant portion of people lack any form of emergency fund. Don't let yourself be part of that group. Start today, no matter how small the amount. Each dollar saved is a step closer to financial independence and resilience. Once you've built this fund, it doesn't mean the job is done forever. You'll need to revisit it periodically. If your expenses grow or you face a major life change, adjust your emergency fund accordingly. Think of it as a living, breathing safety plan that evolves with you. Without a solid emergency fund, even the best financial strategies can collapse. With it, you're protected and ready to tackle the next big step, paying off debt and building investments. Curious about how to maximize your paycheck further? Let's find out. Pay off debt and invest in tax-advantaged accounts. Debt is the silent thief of wealth. It chips away at your money, leaving little room for growth. Before you can build a solid financial future, you need to tackle high-interest debt head-on. Start by listing all your debts, their balances, and their interest rates. This clarity is your first weapon in reclaiming control. There are 2 popular strategies to pay off debt: the avalanche method and the snowball method. The avalanche targets debts with the highest interest first, saving you more money in the long run. The snowball focuses on the smallest debts, giving you quick wins to stay motivated. Both work. Choose the one that suits your mindset. High-interest debt, like credit cards, is especially dangerous. Imagine paying 20% interest on a $5,000 balance. That's $1,000 a year drained from your pocket. By prioritizing such debts, you're essentially securing a guaranteed return far greater than most investments can offer. Once your high-interest debts are gone, you can shift your focus to tax-advantaged accounts. These accounts, like Roth IRAs in the US or stocks and shares ISAs in the UK, allow you to grow your wealth without worrying about taxes on gains. Think of them as a legal loophole to keep more of your hard-earned money. For example, investing $250 monthly in a Roth IRA, assuming an 8% return, could leave you with over $1.3 million after 45 years. Completely tax-free. Platforms like Vanguard or Fidelity make it easy to start. The sooner you begin, the more time compound interest has to work its magic. Automation is key here too. Set up automatic contributions to your investment accounts right after paying your essential bills. This pay-yourself-first mentality ensures your financial goals stay a priority. Think of it as planting seeds for your financial garden, nurturing it month by month. Tax-advantaged accounts aren't just about retirement. Many also offer flexibility for major life expenses. For example, some allow penalty-free withdrawals for a first home purchase or education. These features make them versatile tools for building wealth while keeping future options open. Don't let tax jargon intimidate you. Educate yourself on the basics of these accounts and consult a financial advisor if needed. Wealthy individuals don't just earn more. They understand how to shield their income from unnecessary taxes. You can do the same with a little effort. Imagine being debt-free and seeing your investments grow steadily over time. This dual approach, eliminating debt and leveraging tax advantages, puts you in a position of financial power. Instead of paying interest, you're now earning it, flipping the script in your favor. While paying off debt, avoid new ones. That tempting credit card offer or car loan might look harmless now, but it's a step backward. Adopt a cash-first mindset for discretionary spending. This discipline builds a strong foundation for wealth and keeps you in control. Even as you focus on paying off debt and investing, don't forget to celebrate small victories. Each debt cleared or investment milestone achieved is a step closer to financial freedom. Treat these moments as reminders of your progress and proof that your strategy works. Success is built on consistency and persistence. Once you've mastered these strategies, you'll have a new problem: deciding where to allocate your extra cash. That's when diversifying your investments and exploring higher risk opportunities becomes exciting. Ready to take your money game to the next level? Diversify with high-risk investments and automate. Once your financial foundation is solid, it's time to play offense. Diversifying your investments allows you to balance risk and reward, opening doors to potentially lucrative opportunities. Start with 5 to 10% of your paycheck for high-risk, high-reward plays like startups or niche markets. This approach can accelerate your journey to millionaire status. High-risk investments aren't for everyone, but they can offer tremendous rewards. For example, investing in early-stage companies or emerging technologies like renewable energy can yield massive returns if you choose wisely. Research is key. Follow trends, read reports, and understand the industries you're venturing into. Cryptocurrency is another option for those comfortable with volatility. Allocating 5% of your portfolio to Bitcoin or Ethereum can provide exposure to this growing asset class. But remember, the crypto market is unpredictable, so only invest what you can afford to lose. Think of it as a calculated gamble, not a guarantee. Starting a side hustle or small business is another way to diversify. Whether it's freelancing, selling handmade goods, or launching an online course, businesses have the potential for exponential growth. With platforms like Etsy, Fiverr, or Shopify, starting a venture has never been easier or cheaper. Automation makes managing your investments and side hustles less stressful. For instance, auto-investing in index funds like the S&P 500 removes emotion from the equation and ensures consistency. Similarly, using tools like scheduling apps or automated marketing software for your business saves time and boosts efficiency. Diversifying doesn't mean ignoring traditional investments. Index funds, real estate, and bonds should still form the core of your portfolio. Think of high-risk options as the spice to your financial recipe, not the main ingredient. A well-rounded portfolio is the hallmark of sustainable wealth. Networking is crucial in high-risk ventures. Surround yourself with people who are knowledgeable in the industries you're exploring. Attend seminars, join forums, and build relationships that can open doors to investment opportunities you might never find on your own. Even when diversifying, set boundaries for risk. Never invest money you can't afford to lose. High-risk investments should complement, not jeopardize, your financial stability. This disciplined approach ensures you can take chances without putting your financial health at stake. Picture this. You've diversified into multiple income streams, from stable investments to high-risk ventures. The result? A financial ecosystem that not only sustains itself but also grows exponentially. Wealthy individuals didn't get there by playing it safe. They diversified strategically. As your portfolio grows, automate your processes even further. Set up systems to reinvest dividends, rebalance your portfolio, and streamline your side hustle. This frees up your time to focus on finding new opportunities while your wealth works for you in the background. High-risk investing isn't just about making money quickly. It's about learning the art of seizing opportunities. Each risk teaches you something new, sharpening your instincts for future decisions. Even failures hold valuable lessons, paving the way for bigger wins. Once you've mastered diversification, it's time to refine your strategy and explore what's next. What's the next level for your financial growth? Let's find out. Before we wrap up, make sure to subscribe to the Rich People Club and turn on notifications so you never miss the strategies that could transform your financial future. If you're serious about becoming rich, this is the channel that will guide you every step of the way. Now, it's time to take action. What's the first step you'll implement with your next paycheck? Will you start cutting unnecessary expenses, build that emergency fund, or finally pay off those high-interest debts? Drop your answer in the comments below. I'd love to hear your plan. And if you're wondering what to do with all the wealth you'll accumulate, stick around, because we've got even more strategies coming your way.